get listed, retail goes crazy, the price goes up, folks basically dump on retail. And you spin that loop as fast as you can, and you can extract an enormous amount of money. Along the way, all these things like DeFi all of a sudden popped out of nowhere. And it's like, hey, you can earn 15, 16, 17, 18%, just deposit the Bitcoin. Bitcoin activity as a function of year and value. Nick, can you just put that up just so that we can look at that together? The crazy thing about this chart when you look at it is, and it's pretty obvious, is that we are collectively in one way, shape, or form basically trading up ever since 2018, really, with all the stimulus. Because if you look at, the mean price of Bitcoin of 2018, it was a nothing burger. What we were talking about was, a price that was sort of between a few $1,000s, $2,000, $3,000, $10,000, and then $3,000. And then all of a sudden, when all of this stimulus money hit the market, look what happened to it. Yep. But I think something unique also happened, which is that people really understood how to run these very complicated off-chain Bitcoin ARBs. And I think we should explain what those are, because those are what's behind the Three Arrows Capital. It's behind, I think Sam had this kind of oblique tweet that said, some of these exchanges are actually already insolvent. They're already the walking dead. So the first thing to keep in mind is that, this is a completely unregulated market, right? There are no market makers per se that actually have reporting requirements to any regulatory authority. There aren't any clearing houses. There isn't a way for us to understand systemic risk as it builds in the crypto market. So what happened starting in 2018 and 19 is people realized the following things were true. It's sort of what we talked about last week. You go and do some crazy round. You, mark up some phantom equity in a company. That company then issues tokens. You then list the tokens, not on, a blockchain per se, obviously, but in a place where trades can happen off-chain. Right. And there's a bunch of exchanges where these things happen off chain because it's one, company, and then they have a bunch of segregated sub-accounts. And what happens is when these things initially get listed, retail goes crazy, the price goes up, folks basically dump on retail. And, you spin that loop as fast as you can, and you can extract an enormous amount of money. Along the way, all these things like DeFi all of a sudden popped out of nowhere. And it's like, hey, you can earn 15, 16, 17, 18%, just deposit the Bitcoin. And so folks would deposit Bitcoin. But then what would happen is like the places where those deposits were held would then need to obviously find places to make that 11, 12, or 13%. And so then they would go off chain to some other random person who was offering to pay them even more than that. And they would try to arb the difference. But it all catches up with you because when something like a Terra goes to zero, all the Bitcoin that was used to basically, run that DeFi process around Terra vanishes, and then all of a sudden you, the lender, are like, hey, can I have my Bitcoin back? And the broker's like, well, actually, I don't have it. I lent it to somebody else. Let me ask that someone else. And they're like, I'm sorry, I don't have it, but I have these Terra coins, because I was running some ARB and now it went to zero. And that's essentially what we're seeing right now. So we have two big problems. And then I think we have a third that's kind of funny. The first big problem is like, obviously in the absence of any regulatory oversight, this stuff is going to happen. Systemic risks are going to build up. That's what we're facing right now, is an enormous amount of systemic risk, largely around Bitcoin. A bunch of this money, I think, has been essentially just vaporized. And so all these people that try to find their deposits, especially in custodial accounts in off-chain brokers, may be SOL at some point. And I think that's just going to be a huge shit show if that actually happens. And all of this other interrelated parties that are now, gone completely bankrupt because of this scam, the answer is absolutely not. So that's the first problem. You have absolutely zero oversight, which means systemic risk has been built up in the system. The second thing is that exactly what you just said, Jason, is that people don't even understand chain of custody here, which is that you thought that you owned this Bitcoin. It turns out you actually may not actually own them at all. You thought that you were properly lending them out. You actually don't. There is no enforceable contract, it turns out. And so I think that's going to be an entire set of different legal issues that are now going to come to the surface because people who actually legitimately lent this stuff out. For example, like if you short a stock and you go and borrow stock from any one of us, there are really tight guardrails, you know? If you wanted to go and put a credit derivative swap on against debt, there's a central clearinghouse that makes sure you're not over-levered. You know, you have to go and get audited by a bank to even get the kind of account that allows you to put these derivatives on. None of that was possible in crypto. And then the last thing, which I think is kind of funny, is that we've had to listen to every millennial and Gen Z market observer in crypto tout how this is not like boomers, and they turn out to be the same. I mean, this is the funniest thing of all. It's like of all of the times you've had to hear how it's so different, it turns out it is entirely the same. Entirely the same. In fact, worse. He's a very sophisticated player in not just crypto, but frankly, regulated and unregulated finance. And look, I think he spends a lot of money in DC as well. And I think that he has a very thoughtful game plan. And then, you know, when you look at who his parents are really, really smart, thoughtful people as well, 2 law professors at Stanford. And so I suspect, not knowing and having spoken to him, that I think that there's a really specific strategy that these guys have around who they need to influence and what they care about, and then willing to, as a pass-through, fund those things in order to create the, you know, influence that he needs for the things that he cares about. And I suspect that it's that kind of horse trading, which is, I think it's pretty typical in US politics. The question though is what will happen if FTX has to really talk about, you know, everything that's actually happening in crypto. You know, I'm sure that FTX could do a lot to help understand a lot of this off-chain activity, some of the, you know, especially the stuff that's really in the gray, especially the stuff that's going to come to light over the next few years. I mean, you have to understand, guys, like, you know, we've torched $2 trillion and it's not of institutional capital, you know, this is overwhelmingly retail capital. Especially when everybody was telling you, no, this time is different. This market is completely different. It's transparent. It's on chain. You can see and it turns out actually most of it was not on chain. It was off chain. That they found all of these words, you know, written in these economic textbooks that allowed them, frankly, to justify what a lot of people were doing in a lot of other markets, which is just straight up speculation because the money printer was going burr. And, you know, if you look at this 92% correlation to the equity markets, I suspect in Bitcoin and crypto is probably closer to even 100%. Because it really was the furthest out on the risk curve. And it just made the most sense when you thought money was, you know, effectively infinitely going to be available to just buy the riskiest risk assets. Absolutely zero rules and oversight.
No oversight, yeah.
The feature that was touted was actually the first one to get thrown away, which was transparency.
Yeah.
When all of this activity was actually happening off chain, this is why you have this systemic risk issue now. When Sam is saying some of these exchanges are actually insolvent, what he's saying is, well, that exchange has one master wallet address. Every time you open an account and transact on such exchange, you're actually just transferring between a database entry inside of that company. And so it may look like it is fine, but it is actually not fine. That's what he's claiming. This is the problem with all of this. So all of this activity, you know, built on these principles of openness and, you know, defensibility and, you know, you can't inflate it and, you know, devalue it and debase it, turned out to not even matter because the fundamental principle that would allow us to verify all of that was violated right from the get-go, which was transparency. All of it is happening in the dark. Most of this stuff is happening off chain. And if you think that, you know, it's okay to torch $1 trillion of equities, well, at least there's rules on the equity side. But to torch $2.5 trillion in crypto where there are no rules, it'll be really, you know, it'll be a very telling sign to see if these folks get their act together, and but meaning regulators and politicians, and do something.
Discovery.
Jason, if you look at that price chart, what it really means is, like, again, you know, we talked about this. If the equity markets have to rebase and get all this QE out of it,
yeah,
right? And then you have to rebase for earnings if you believe you're in a recession, and then you have to rebase for margins if you believe that there's rampant inflation. Those three things have to happen in the equity markets. We're in the midst of that.
Yeah.
But that also has to happen on the crypto markets, in the crypto markets. And if you look at that chart, What it really tells you is that the baseline price of Bitcoin, where things seemed, where rational supply and demand were meeting each other before all these,
10,000?
3,500 to 5,000.
Yeah, I would say about 5,000.
That's still 75%. It's not that they wanted to go private. I think that they wanted to stay public and they wanted to build a large business. But this is where the law of large numbers catches up with every company. That's why it's so rare to have an Apple or a Google or a Microsoft or a Facebook or a Netflix, where you can grow for 20 years at 25+%, because at some point, 25% growth over last year just becomes too hard of a amount.
It's a big number.
And so what Zendesk suffered from is what most of these SaaS companies, and I'm not trying to disparage them, just calling it out, will have to go through, which is the following. The easiest kind of SaaS company to start, and the one that folks, really talented investors like Sachs will fund overwhelmingly over others, are what's called bottoms-up SaaS, right? Things that sell to the low end of the market, things that sell into, SMBs.
Individuals can buy them in a corporation as opposed to the CIO.
Yeah. The unfortunate part of that growth curve is that it's pretty terminal within 7 to 10 years. And after that, you're forced to go to the mid-market, and then eventually you're forced to go enterprise. But when you go to the mid-market and you're selling to 500, 1,000, 2,000 person companies, and then eventually even enterprise, you're talking about massive investments of OpEx. People, engineers, product managers, salespeople, and all of that stuff costs money, and it's not clear that your product is any good. So in the Zendesk's example, it's not to say their products were bad, but all of a sudden they were going up and selling a CRM tool, a Salesforce automation tool, and now you're going head to head against companies like Salesforce who are going down market. And all of a sudden Salesforce and Microsoft and all these companies can play very aggressive pricing games with their products. They can bundle all kinds of other things in for free. They can give you discounts. And it's very hard to compete as a single individual company. So your growth starts to stall. So I suspect what happened at Zendesk is they said, we can make it. And we believe in ourselves. And they found that it was hard. Then instead of organically growing, that's when they turned down the $17 billion offer. They tried to grow inorganically. They looked at SurveyMonkey, right, which our friend Xander runs, and said, we're going to try to buy that for $4.1 billion. And the market said, no. And then the market basically contracts. And now they're like, well, if we go and now torch our EBITDA goals and tell the market we're going to go and spend all that $1 billion we have to try to go up against Salesforce and Microsoft with a product that we don't know is going to work, our stock's going to be at $1. And so I think that that's sort of the parade of terribles that happened for them. But it's a little bit of a warning sign for how difficult it is to get big. Like what Salesforce pulled off, right? And what Workday is starting to pull off, what ServiceNow has pulled off. I mean, you can't underestimate the quality of these teams.
Google, Apple, Facebook.
No, I'm saying specifically enterprise.
And SaaS, yes.
Those companies, ServiceNow probably being the last one that's really did it, incredible. So difficult. Palo Alto Networks is probably the next closest one now.
And Salesforce did it through acquisitions, let's be clear, right? Salesforce
doesn't matter how you get there. Organically, inorganically, it doesn't matter. The point is, it's very hard. Most CEOs fail. Nobody accomplishes.
So is this going, so my original question is this the bouncing along the bottom moment?
No.
Because we have Peloton, we have BuzzFeed, we have so many of these companies.
Jason, this is a warning sign.
Okay.
This Why? Is not yet the
how
bottom.
So?
Well, this is a warning sign that says you cannot go into a massive investment cycle for all companies unless you can prove that you can sustain margins, sustain growth, and minimize OpEx.